The next big test for the market is going to be earnings. We've got big bank earnings kicking off later this week. We're starting on Friday with JPMorgan, Wells Fargo, and BlackRock all reporting before the bell. To discuss how investors should be looking at the reports and maybe how to position ahead of that is Macrae Sykes. He is a Gabelli Funds portfolio manager. Macrae, it's great to have you here on set. So talk to us about what we should be expecting from bank earnings, from the financial sector at whole, because when you take a look at those estimates versus zeroing in just on the banks, there's a little bit of discrepancy. So what should investors be prepared for?
Well, I think overall, I think it should be a pretty good earnings season. We do know that there's going to be some headwinds from NII that's shifting around a little bit, but the S&P Financials is up about 10% for the quarter, so good anticipation of the results. You have the S&P up 6% during the quarter. That's good for wealth and asset management contribution in terms of fee revenue. Deposits up 1%, 4% annualized, so that's supportive of balance sheets. NIMS kind of, in the same. We had this surprise 50 basis point cut versus 25 in the quarter. That's not really going to be impactful, but that gives a good setup for going forward in terms of the net interest margins more normalizing and getting better going into 25, 26. So I think investors are going to be looking through these earnings, looking for better earnings acceleration in the next years. And of course, the consumer's doing pretty well, credit's doing pretty well, so pretty good setup as well.
What can we expect to learn on not just the health of the consumer, but also the economy and the degree to which that larger than anticipated rate cut is impacting banks' balance sheets?
So I think there's a lot of data points that's going to be going in, and you have a firm like JPMorgan, very asset sensitive. There's going to be some pressure on their balance sheet going into next year, and they've talked about that. They lowered guidance a little bit at the last quarter, but you're talking about something generating 91 billion of NII this year, maybe down below 90 next year. So kind of a little bit of a headwind as opposed to Bank of America. With a net interest margin ratio of around 2 versus 3 for JPMorgan, is going to start to see that benefit a trough this year and acceleration next year. So, the tale of a couple of cities there. And that's the case of a lot of the different banks. But in general, I think better NII metrics going into next year.
What do you think the commentary is going to be surrounding the shift that we've seen from the Federal Reserve? So we did get that 50 basis point cut, but I think obviously the debate and the conversation that we've had with so many of our guests here over the last couple of days has been whether or not, or I guess to the degree that they're going to be cutting here before the end of the year. How much will that then, if we only see 25 basis point cuts between now and the end of the year, how much is that then going to delay maybe the recovery that we're expecting to see in banks?
So we try not to focus too much on the monthly metrics in terms of predicting rates.
Right.
Obviously we follow the 10-year and what's going on, and that's our North Star, and that's actually been flying quite around, going from 360 now up to 4. I would say, though, even though the 50 basis points was a surprise versus 25 probably as expectations, I think the layout in terms of the rate cuts over the next 6 months by the Fed and getting that, whether it's another 50 this year, and what the forward curve suggests, or I think that's well within kind of the expectations for the banks as well. So to the extent that we start to get slow rate cuts, I think the banks will react accordingly, and that will be a good environment. And then we've seen the rate curve in general flatten out, so stop the inversion, and I think that's a good path to recovery in terms of managing your liabilities and assets.